This conference will now be recorded.
Okay. I'm also going to be monitoring the chat. So if anyone has any questions during the class that Brian's teaching, please feel free to put your questions in the chat, and then we'll acknowledge you. And then feel free to unmute your mic and go ahead and share that, or else I'll just read your chat question. So I'm going to turn everything over to Brian. So go ahead and get
Okay.
started, Brian. Thank you.
Awesome. Thank you so much. I first want to, thank Linnea and Ella for sponsoring this First American Title. They're giving everybody a 1 hour CE credit this morning. So that is super awesome. So I guess, so I'm going to talk about reverse mortgages, obviously, and ultimately I want to talk a little bit about how I might be able to help you with buyers, because reverse mortgage over the last few years is now you can use these to actually purchase a home. But I thought I'd just start out with the basics of what is a reverse mortgage, kind of how it works, and then work our way to actually showing you how to use one to potentially help a borrower purchase a home with it. So I have not used GoToMeeting yet. So can you see my screen where my cursor is right now?
You have to actually push the button to share your screen. It's at the bottom of the page. Do you see that?
Aha. Okay, I see it.
Yeah.
Oh, it's got a little. Oh, I see. Okay. All right. Aha. Okay, I think I got it here.
Now we can see it.
Okay, so I'm gonna go. All right. So you see my cursor?
Yes.
Okay, awesome. So, I guess let me ask, and people can respond in the chat, or chime in, and I want you guys to know that you can chime in anytime. But what what uh, what have people heard about reverse mortgages? What are some of the things that you've heard? I always like to know what there's some things out there that some are true and some are not, and maybe we can address those throughout. So you can chime in now or you can chime in throughout. So anyway, I'll let you guys chime in whenever, and I'm just going to start in here and just talk about the basics about what is a reverse mortgage. Ultimately, it's a mortgage. It's originally put together for people to convert home equity into cash. I think most people think about a reverse mortgage as something that you're out of money and you can, tap your home to create an extra income stream during retirement. Um, One thing about a reverse mortgage that a lot of people don't know about is the homeowner actually retains title. I hear all the time, people saying, "Oh, the bank's going to get my house or the government's going to get my house." That's not true. It's just like any other regular mortgage. If you get a 30-year fixed or a 30-year FHA or a VA loan, you're on title throughout. Um, so home equity conversion mortgage, or HECM stands for home equity conversion mortgage. That's just FHA's name for reverse mortgage. And as you see, they're only through an FHA approved lender. Banks used to do these a lot and kind of got away from them about 10 years ago when there was some bad publicity about these. And one of the things that used to pop up on the front page of the newspaper is you have to be 62 or older to get these, but if you had a spouse that was under the age of 62 when they originally got the reverse mortgage, that younger spouse had to be taken off title. And you can imagine the problems that would create if the older spouse died down the road and the younger spouse had to scramble to get put on title. And I think they had 90 days to do it. And if that didn't happen because they were grieving and they just forgot about it, then the bank would initiate foreclosure proceedings. So FHA has stepped in and fixed that. So you can be 62 and be married to a 52-year-old, and both folks are on title throughout. So if the older person dies, the younger person who wasn't on the loan because they were under the age of 62 still can stay in the home for their entire life and never have to make a mortgage payment. So that's kind of cool. That's been fixed. You can use these, as I mentioned at the beginning, you can refinance an existing mortgage or purchase a new home with these. In the past, you used to have to purchase it with cash or a regular mortgage and then wait a year before you could use the purchase side of things. So FHA figured out that didn't make any sense. It cost a lot of money and created people, made people make a mortgage payment for a year when they didn't have to. So that has been fixed. What does a HECM do? So it secures the home, eliminates payments. You do have to pay taxes. You have to pay homeowners insurance. You have to pay HOAs, and you have to maintain the home. Nobody's driving around and actually looking to see if you're maintaining the home. I think the only way you could really be in trouble for your home not being maintained is if the city actually stepped in and said it was a problem. But they do check and make sure that people are living in the home and making their property taxes and home owners insurance on time. Traditionally, and again, like I talked about earlier, a lot of people think about these as extra cash flow in retirement, converting that equity into cash. And that's definitely one of the things you can use it for. And it is tax-free if you pull money out in any kind of loan, whether it's a 30-year fixed cash out or a HELOC or a HECM, that money that you pull out is tax-free. Another use of these is some people, high net worth people, actually use the line of credit that you can get on these home with the reverse as a buffer asset. For example, if the stock market tanks and drops in half and people don't want to sell their depreciated assets to live off of in retirement, the reverse mortgage has actually been proven to be a nice buffer asset for that. And last but not least, the reverse might be able to increase home buying capacity. And we're going to look at it here in a little bit. But if somebody is convinced that they want to pay cash for a home, but they only have $450,000, doesn't buy them a lot in Bend, and maybe they want to pay cash because they don't want a payment in retirement, but we're going to take a look at a scenario where if they have roughly $450,000, they could buy a $750,000 home and still not have a mortgage payment because they bring in their $450-ish of cash. The rest they put on a reverse mortgage, and then they can still be in that same position that they wanted to be in the first place, which is just not having a payment. But it increases, they're not going to have to maybe commute 40 minutes to Bend to see their grandkids. Potentially, they could just get a house here in Bend with that reverse. So I know I'm just kind of peeling along here. Any questions so far?
I don't see anything in the chat yet.
Okay. All right. So as I mentioned, requirements, you have to be 62, must maintain the home as your primary residence. You need to pay property taxes and homeowners insurance and any HOAs. And you do have to go through an underwrite. There's basic credit and residual income qualifications. Another thing that, other than the title thing I mentioned, where one spouse was younger than 62, the other thing that they used to, I think 15, 20 years ago, all you had to do is be 62 or older and have a lot of equity in your home, and you could get one of these. They didn't check their credit and their other assets to see if they had the means to actually pay their property taxes and homeowners insurance. So what would happen is they'd get get in the house, get the reverse, and then they'd stop paying their property taxes, and then there would be a lien placed and then foreclosure proceedings. And then there would be a big front page article in the newspaper in the business section saying, somebody lost their house due to a reverse mortgage, when reality is they just didn't pay their property taxes. But so FHA wanted to fix that so they're not on the front page anymore. So they actually underwrite them and just make sure they have the means to pay those extra costs. And you got to do counseling. So, anybody 62 or older is considered in a, protected class, and they want to make sure that everybody understands that if you don't make a mortgage payment, your mortgage actually gets bigger over time. So what happens is that interest that accrues that you normally make with a 30-year fix you pay each month, you don't do that. Your first payment's actually not due until you move out of your home. So just opportunities, these are really, there's some pretty high cost to set these up, and we're going to go over that. But really it's for, these were set up for folks that really want this to kind of be their last house before, they either pass away or, move into some place where they need assistance. We already went over that. Now, if you make payments, you can build a line of credit, and we're going to take a look at that. And now your spouse and heirs are protected with reverse mortgage. A lot of people ask, what happens, if 2008 happens again and I owe more than my house is worth? Well, it's what's called a non-recourse loan. And that means nobody is on the hook for the loan except the house. So what that means is if, let's say, the house is worth, I don't know, $200,000 because we're in 2008 again, and the people have had a reverse mortgage for 30 years and they owe 400. Well, once the house sells for 200, that's it. Nobody's on the hook. Even if they pass away, the kids can sell it for 200, and FHA steps in and pays the other $200,000 that's owed. So there's actually it's kind of a unique thing. The kids can actually get it for 95% of current market value. So if the kids wanted the house, in that case, the market value is 200,000. The kids could get it. Actually, would only have to come up with $190,000, and the other $210,000 that's owed is forgiven by FHA. All right, so that's that. So we're going to take a look at, let's see, actually, I'm going to go back here. We're going to take a look at kind of how these things work, and we're going to look initially at what most people use it for, which is to create an income stream, or at least a line of credit. So we're going to look at how much you can borrow, and how much you can borrow is based on the borrower's age. So in this case, we're using 60 years of age, the property value, and now because these are FHA loans, in this case, I had done this loan for these folks. Their house is worth $2 million. But FHA will only let them borrow against $970,800. So their initial principal limit, or what they're allowed to borrow out of the gate, even though it's a $2 million house, is $503,000 because it's based on this 970. When we look at modeling, we're going to show a home appreciation of 4%. We're going to look at that here in a second. Now, as I mentioned, closing costs are a little steep. And that's because, like a VA loan or a traditional FHA loan, there's a funding fee in there. The funding fee in a reverse mortgage is 2% of the home value. So out of the 503 that's available, they pay off the closing costs, and left over is this line of credit of $474,000. The first year, FHA puts a kind of a regulator on it. They don't want them to have access to the entire loan amount, so they have access to about 60% of what's available to them. So I'm going to show you. So here's the scenario. They just got their reverse mortgage. Here's their home value. Here's their initial loan balance, and that is the closing costs that it were to set it up. Here's the home equity in the home. So if they sold it a day after they closed, they would, sell it for, a little over 2 million, pay out the closing costs and still net about 2 million. But here's the line of credit. And here's what's available in the first year out of the line of credit. So again, they're age 68 over here, but look, I'm going to toggle forward 1 year and watch the liquidity in the line of credit. They're going to equal each other. Now, as you see, the line of credit grew. That's growing at whatever interest rate that their reverse mortgage loan is. So this is their loan out of the gate. It's roughly, I said $28,000. So that's growing at about 4 or 5%. But the line of credit is also growing at 4 or 5%. And the cool thing about a line of credit with a reverse compared to a HELOC, it's the only line of credit that cannot be canceled if your home value goes down. And that's huge. If anybody was doing real estate back in 2008, I'm sure everybody knows somebody that had a home equity line of credit frozen or taken away from them when their home value started going down. Whereas if your home value became worth $1 in this scenario, you'd still have a line of credit of $474,000, which is huge when things are hitting the fan, especially in retirement. So I am going to, let's just for fun, I'm going to show you this line of credit and how it can really be something that can be used later, just kind of as a backup if they're not drawing on it, for a monthly income. So I'm going to go out 5 years. So we're out at 5 years. So that line of credit's all the way up to 591,000. Go out 5 more years. It's $736,000. So let's say something happens to them. They want to buy a second home. They could actually draw this whole line of credit and use that to buy a second home. So because the reverse is on their primary residence, there's no mortgage payment on that. They bought the second home for $730,000. So now they have 2 homes basically with no mortgage payment. I'm actually doing one of those right now. They have a second home in Calistoga and they're doing a reverse on their primary residence. They own free and clear. And so that reverse is about $500,000. And so they have a $500,000 reverse on their primary, which they're not required to make a payment until they move out. And they now paid off their loan on their second home in Calistoga. And so they have 2 homes and no mortgage payment. So kind of cool. But let me show you if you used one of these in kind of the traditional, when you see Tom Selleck pitching these late night TV, he's talking about using these as income. So let's say somebody wanted to do a $1,500 a month draw, and let's say they do it for 10 years. So watch the amount borrowed. It's going to grow. Their line of credit is going to go down, but not by $18,000 a year because that line of credit's growing. So I'm going to go out 5 years. 1, 2, 3, 4, 5. So the line of credit has actually grown even though they're drawing $18,000 a year. And again, that's tax free. So they could, supplement their retirement income with something like this. So, and as a reminder, that home valuation, we're using 4% because that's what FHA uses. So if the home appreciates to 4%, I'm going to go back to the beginning. If the home's appreciating at 4% and you're drawing $18,000 a year, we'll look at 5 years. But originally you have just over $2 million of equity. We'll go out 5 years. You still have more equity as long as the home's appreciating even nominally. So kind of cool. Now you can make payments, but we're not going to look at it on this scenario. So any questions so far? I'm used
I
to
don't see
doing this
anything.
live, so it's different. I feel like I'm in a closet somewhere. So
Yeah. Tina, do you
I
have a
have
question?
I do have a quick question. I'm not very familiar with these. So in order to do this reverse mortgage, you have to have your home paid for? No, you don't owe anything on it?
no, actually, no, you don't. And the next scenario we're going to look at, we're going to pay off a mortgage with one of these. So you need to have roughly about 50% equity to do a reverse mortgage, though, because they don't let you borrow as high of a loan to value as a traditional mortgage, because the assumption is people aren't going to make a payment, so that loan balance is going to get bigger over time. So FHA, because they're backing these, doesn't want to have, owe more than the house is worth until, way down the road, if ever. Does that make sense?
Yes, thank you.
Okay. Yeah. So let's look at that. So I was going to look at the paying off. So I'm going to go.
Yeah, we have a question here in the chat, Brian.
Oh,
Jane's
okay.
asking, so basically a reverse mortgage gets paid off at the end of the term or death, etc. of the seller. Is there any time there is equity left at all?
Yeah, absolutely. Let's go back to the one we were just looking at real quick. So they're doing that $1,500 a month draw, and for 10 years. So let's look at age. We're going to go out 10 years. Yep. Actually, sorry. Yeah, we'll go out to 78. Okay. So again, the house started at about 2 million, and now at 4% appreciation over 10 years, it's worth 3 million. You've been drawing $1,500 a month for the 10 years. So now you've borrowed 270 total. That's with that's with interest accruing and everything. So if they sell the house after 10 years, they're selling it for $3 million. They're paying off what they've borrowed, which is 270,000. This is their equity that they get to take with them. So yeah, you can be in a situation where if your home went down, then there would be no equity to take. But if your home value is going up, as long as your home's worth more than what you've borrowed, that equity is yours to keep.
Great, thank you, Brian. I have two questions from Cinda. First one from Cinda is, I might have missed this, but what about taxes?
Yeah, that was one of the things we started it right at the beginning. You're required 4 requirements on these. You have to pay property taxes, homeowners insurance, HOAs, and you need to keep the house maintained. So those are your responsibility on the side.
Okay, thanks. And then Cinda has another question here. Do you pay on this income? I think she's referring to this. Cinda, do you want to unmute your mic and explain that a little bit better? Oh, do you mean income taxes?
Yeah, I mean income taxes. It's income from your property. So are you paying on that?
No,
Capital
it's
gains.
tax-free because it's a loan. So, if you needed, you could actually draw this instead of from an IRA, which is taxable, for example, to keep your, a net worth larger by drawing tax-free money in retirement from one of these. So, yep, no taxes. That good?
Okay. Yeah, I think Cindy, you got that. That answered your question, right?
Yes, it sure did. Thank you so much. That's really interesting.
Yeah,
To
you're
draw
welcome.
on your house instead of drawing your IRAs. And
That's exactly right. And the thing, I didn't mention, you guys, the thing that, so I've been doing mortgages for 20 years. I'm at Fairway Mortgage here in town. And the thing that got me excited about when I learned about these 4 years ago is that it was the whole class was taught from a financial planning perspective. Over the last 10 years, people with PhDs have jumped in and studied these as actually a retirement complement to other things. And there's a guy named Barry Sachs, and I didn't know who Barry Sachs was, so I Googled Barry Sachs, and well, he only has an undergraduate degree, double undergraduate degree from MIT, and a PhD in physics from MIT, and he has a Harvard Law degree, and he practiced tax planning in San Francisco. And when he retired, he wanted to look at the most efficient way he could retire income-wise. And what he found out and proved, and it was actually published in the Financial Planning Journal that all the financial planners look at, is that even a highly affluent person generally leaves more money behind, maybe not as much equity, but overall holistically all the retirement accounts and everything added up, plus the home equity, they generally leave more by doing some kind of coordinated strategy where you're tapping the house to, complement your other income needs. So
Great, thank you.
yeah, okay. So let us look at that scenario that somebody mentioned about, can you use these to pay off a mortgage? And I called that payoff. And remember for a second, had to look at my notes. Okay, so in this scenario, we're looking at a 70-year-old. Their home value is $825,000, and because FHA lets you borrow up to $970. In this case, our home isn't over that $970 mark. So what they're allowed to borrow against is called the max claim amount. That's $825. So based on their age of 70, current interest rate, and the value of their home, they're allowed to borrow up to $367. So they currently have a $250,000 mortgage. And then they finance in their closing costs. So their new beginning mortgage is $277, but left over out of that $367 is $89,700. So as I mentioned, FHA caps what you can borrow in that first year, but let's take a look at, we're going to look at the payoff here. So we're looking at, so here's your home value. There's your new mortgage. It was $250 with the traditional mortgage, but now we're able to turn off that cash flow. Actually, so in this case, they had a $250,000 mortgage, spending $1,575 a month. They have 213 months left. That is almost $19,000 a year cash flow that they have to draw from either IRAs or pay from pensions or Social Security that they no longer have to pay anymore with the reverse. So let me go over here. So now we're looking at the actual reverse. So there's your home value. There's what you borrowed. And here's that line of credit. And here's what they have available from the line of credit in year one. And I'm just going to go out 5 years again. So watch everything grows. Okay, so after 5 years, let's say they need to move. The house was $850. Now it's worth $1 million, just at 4% appreciation. They haven't made any payments, so their loan balance went up. So they now owe $371. So if they sell their house that year, sell it for $1 million, pay off their mortgage, and this is theirs to take with them. Now, if they don't sell and they need to use this $120,000, they can do that. What would happen is they just tap all 120 and it would get added to your payoff amounts. And then they'd owe $490. We'll go out to 10 years here. So anyway, I love these if there's a line of credit, just because, everything I read with, long-term care costs and health costs and everything like that, it's nice to just have something that's there in case something happens down the road, but you don't have to use it if you don't want to. So, okay, now any questions on that before I move on to the purchase option?
I don't see anything.
Okay, so let's look at the purchase arm. Okay, so as I mentioned briefly at the very beginning, to use these things as a purchase is fairly new. They used to not allow you to do it. So somebody would have to like go get a traditional loan on a house or pay cash for it. And then there's an FHA waiting period of, I believe, a year. So if somebody truly wanted to reverse, they had to, go through the rigmarole of getting a traditional financing, pay the closing costs on that, make payments for a year, and then they could do a reverse mortgage. So sometime in the last 10 years, FHA stepped in and said, okay, we're going to just, cut out all of that. We're just going to allow somebody to use one of these to purchase a home. It works the same way as what we looked at before. In this case, we're looking at somebody that's age 64. They're buying a home of $750,000. And based on their age, they're allowed to borrow $297,000. So if somebody has a $750,000 purchase price, they've got to come in with about $481,000, and that includes closing costs. So let's see. So what I did to set this up, I showed that they have savings of $650,000. That's where they drew the 481 from. And let's just call that proceeds from the house that they just sold. So let's say they don't want to spend all 650. Even if they did, they couldn't buy that $750,000 home. So this case, they only have to spend 481, and they'll still have some money left over, liquid, that they can live off of or fix up the house. So let's take a look at that, what that looks like. So they drew the 481, like I said, for their down payment. Purchase price is 750. They're going to borrow 297, and they finance the closing costs. So here we are. Now this is there's two different. I didn't mention this at the beginning because most people use a line of credit reverse. There's a fixed option too. Fixed option doesn't give you the line of credit. And when you're buying a house and you're maxing it out, it doesn't really matter, but there's some tax benefits of having the line of credit, even with the purchase down the road. We can go into that either in this conversation another time, but this is the line of credit option. So there's the home value. This is what they've borrowed. There's their home equity. And here's what's left over in their savings account. They sold that other home, their previous home, for $650. So they were able to pocket almost $169,000 and put that with their investor or whatever, so they can make some money on this, and they're not completely cash poor. So let's just take a look at this. If we go out a few years, go out to age 69, there's their home value, amount borrowed, there's their equity. So it's more than they started with, even at only a 4% appreciation rate. And if you look over here, there's their savings, and that's growing. And we use a 5% growth rate on that savings column. All right, I'm going to show you with the same. What if you get somebody that wants to make a payment because they can't sleep at night, thinking that their mortgage is growing over time? So watch what happens if they do, say, they want to make a $1,500 a month payment. So watch up here. There's going to be a line of credit. So because it's an ARM, there's a line of credit attached to this. because they used it to purchase, they maxed it out. But if they make a payment, so anytime you make a payment onto a reverse mortgage, dollar for dollar, your line of credit grows. Now it grew more than $18,000 because, as a reminder, that's growing at about 5% or whatever your interest rate is on your loan balance. So if we go out, 10 years, okay. So the difference, and I love this about a reverse compared to a regular mortgage. Yeah, it costs a little bit more to set up, but if you make payments with this, so your loan balance doesn't grow a whole lot, maybe it would be a little lower if you did a regular 30-year fixed, but you can create this bucket liquid asset in case something happens down the road, or, so you can make your $1,500 a month payment because you want to, leave more equity to your kids or whatever. But if something happens, you can draw this. So, if your roof blows off or whatever, you're not stuck. And, everything I read in financial, the journals and all that kind of stuff is, there's nothing more unsafe than somebody taking all of their monthly income and putting it into an illiquid asset like a 30-year fix. And it's interesting, 46% of people in the United States are still making a mortgage payment after the age of 62. And if they have 50% or more equity, they really don't need to. So anyway, any questions on that, on the purchase aspect of things?
I don't see anything in the chat, or no one's unmuted their mic. So
Okay. Well, okay, I'm kind of flying through this. Just as a reminder, if somebody's using a reverse mortgage, this is approximately what they'd have to come in with for a down payment. Age 62, you're coming in with more because, again, the assumption is you're not going to make any payments while you're living in the home. And these are based almost like life insurance, where they're based on life expectancy. So a 62-year-old's expected to live longer. So FHA wants you to put more down if you're not going to make a payment, so that you don't owe more than your house is worth, at least during your lifetime, hopefully. So 72, you're coming in with about 50%, and 82, about 40%. Let's see. I'm just going to go down to a different slide. So again, one person in the household has to be 62 or older. They are qualified by FHA. I don't know if I was real clear on this, but these are set up for a primary residence. So the borrower must live in the home 6 months out of the year. That's not really completely true. You can travel all year as long as this is your primary residence and where you do taxes from and all that, then it's your primary residence. There is something unique about these, is you get a letter once a year from your servicer saying, hey, are you still in your house? Are you still alive? Are you still healthy, or whatever? Because if you move out, even if you move out, let's say you move into assisted living or whatever, if you're out for 12 months or more, then the mortgage needs to be paid off.
Brian, you said it's an FHA qualified home. So do you have to have an FHA inspection done?
Yes. Yeah. And great question, because sometimes they could need a second appraisal to be done. Now, I haven't seen it done on a purchase, but so even though we have the world of AMCs, Congress and FHA had kind of an arm wrestling match a couple years ago, and Congress wanted assurances that this is a sustainable product. So they made FHA come up with almost like a Zestimate program in their computer system. So when the first FHA appraisal comes in, if their computer thinks the first FHA appraisal is too high, they can require a second appraisal. It only happens about 20% of the time. It's generally in neighborhoods where all the homes aren't exactly the same. I have one on the west side. It's one of those neighborhoods where there's $800,000 house next to a $1.4 million house, and that one was required to get a second appraisal. So. Okay.
Thanks.
Yeah, so let's see, go to here. So just to recap, the borrowers get to keep the title on their home. They do get their credit pulled, and they do need to prove that they have the wherewithal to pay their property taxes and homeowners insurance. If they do draw it, it is tax-free. And there's never a monthly payment, although you are still, as I mentioned, you're still responsible for maintenance, taxes, insurance, and HOAs. So first payment is not required until the last living borrower permanently leaves the home. So let's say mom and dad pass away. So now the property needs to either be bought by the kids, which if they want to, they can come up with the money to pay off the current loan, or they can sell it. And they have up to 12 months to sell the home after their mom and dad pass away. So, and once the home sells, pays off the loan, whatever equity is left over, the kids or whoever the beneficiaries are get the proceeds.
Brian, we have a question from Tina. She's asking, is the credit pulled only on the 62-year-old borrower or all on the loan? So you had given that scenario of the 60, but I think.
Yes,
yeah.
It's generally pulled on both. I think there's a way that it can be done without. They're not really worried about credit score. If that's a concern. As a matter of fact, I was just looking at one of these for somebody that has a bankruptcy. You can actually refinance out of a bankruptcy with the Chapter 13 bankruptcy, and even have had a Chapter 17 bankruptcy within a year. There's a way to do it, so they're not real worried about it. Now, if somebody has a huge debt load, like that co-borrower that's less than 62 has a huge debt load, actually I have one going on right now. We had to show that the co-borrower had enough income to cover that debt load on their own. So I don't know if that answered your question or not. Doesn't really matter what the credit score is, but generally they do have to get their credit pulled.
Yeah, it did answer the question. Thank you.
Okay, you bet. All right. So as a reminder, you never owe more than your home value. So like I said earlier, if the parents end up owing $400,000 and the house is only worth $200,000, house gets sold for $200,000 and FHA steps in and picks up the difference. And then on the purchases, obviously you can purchase a home for 30 to 50% down on a new residence. And so, whenever anybody says, well, I want to pay cash, well, that's a lot of cash nowadays with the median home price at $760 or whatever it is. So, maybe somebody's coming here with $400,000 and you could get them a $650,000 home and they'd still be in the same position as paying cash where they don't have a mortgage payment during their retirement. Go to the next slide here. So here's those FHA requirements, you guys. You can buy a 1 to 4 unit property. You can do these on manufactured homes, just like a regular FHA loan. If it's a manufactured home, it has to be built after HUD started certifying them in June of 76. You can do it on condos. You can do it in PUDs. You can do it on a townhome. And we can close in a living trust. So which a lot of people at that age actually like to be in a trust, and it's kind of a good thing. So reverses are a lot easier than a 30-year fix to get into a trust. So that is that makes a lot of people happy. Here's some unique things about being that you're in the selling and buying business. Seller concessions are not allowed. H for P stands HECM for purchase. So no lender credits, no realtor credits. Sellers can pay for the following: owner's title insurance, home warranty. This is a unique one. If a home inspection is listed on the purchase contract, a copy of the home inspection must be provided to the lender for review. So generally, what I recommend on a purchase is maybe if everybody wants a home inspection, to do an addendum that is not going to be in sequence with the rest of the contract. So the underwriter doesn't have to nitpick a home inspection, just to avoid any issues that might cause. And last but not least here, let's see. Oh yeah, just as a reminder, they do double check, make sure that they, meet residual income requirements and credit history. So yeah, that's kind of it. I'm, not communicating with everybody. I hope I didn't just fly through this and actually made some sense here. I can go ahead.
I was going to say, any further questions? Why Brian is here. Maybe some of you guys have some buyers you never thought about that might be able to utilize this as an option for them when they're purchasing something here. How hard is it? What's the time frame, the escrow time frame? Just like a regular loan, 30 to 45 days?
Actually, we our company, this is unique to our company. We can do a 17-day close.
17 business days or 17 days?
17 days. Yeah.
Wow.
Yeah. I generally ask for 30 days, just for gremlins, but yeah. So generally how that works is we have them pre-underwritten before they go make an offer on a house.
I'm on the.
So yeah, so we can absolutely compete with a normal offer. If anybody wants, I have a pretty nice brochure that's kind of really user-friendly to read. I can understand it, so I call it user-friendly. So I'm more than happy to share our purchase brochure, or anything else, or if you want to contact me directly, feel free. Do you want me to just tell everybody my cell and email right now?
I was gonna say I can send an email out to everyone with your information, and
Okay.
that way, if they have questions following up. Is the brochure, do you just have paper versions or do you have a PDF version?
I have a PDF version that I can email.
Yeah,
folks.
I can send that out to everyone too.
Okay, thank you.
That'd be great. Anyone else with questions for Brian? If not, we still have a couple of minutes. We could still do some haves and wants before we break today.
I have a question. Robert here.
Hey, Robert.
Hi, Robert.
Hey, Brian. I think it was slide 15 at the fine print on that spoke about the heirs buying the home at 95% appraised value.
Yes.
Somewhere in there.
I don't know if it was actually on, was it on that one?
There it is. That was it. Back one. No.
I don't think it was actually on a slide. I think I pulled that one out of my head.
Yeah, right there. Heirs will have 6 months if they want to purchase it at 95% of the appraised value.
You're right. Hey, good eyes. Down there at the bottom.
95% of appraised value. If they're the heirs, the parents have the house.
Yep.
Assume parents. Okay, the home's drawn equity. Why do they have to pay 95%? Why? I don't understand that. Am I missing something there?
Yeah,
Depending on what they borrowed against. Why do they have to pay the going rate to get their parents' house?
Well, so that is if the home is worth less than what is owed on the property.
Okay, that's the case. All right, thanks.
So yeah, so going back to my scenario where the parents owed 400,000, the house is only worth 200.
Right,
In that case, the kids could buy it for 190.
got it. All right,
The
that
other
explains it.
210 is
Thanks.
forgiven by FHA. But yeah, so if the house is, okay, let's say the house is worth 400 and the parents owe 200, the kids could, well, the kids just have to come up with 200. And that's
Right.
it. Yeah.
Right, they have to pay the mortgage off.
Yeah, exactly.
Got it.
Hey, thanks for reading my slides for me. That will make me pay attention a little more.
Yeah, it's our job to read fine print, right?
Yeah, no kidding.
Okay,
And
thanks.
it says here that they have 6 months with 2 90-day optional extensions to
Right.
either refinance the home. Yeah, so they have to remember to do that. Does someone notify them as the heirs? I mean, they're dealing with a lot if parents are gone.
Yeah, no, that's a great question. So what I counsel all of my borrowers to do is in their packet of everything that goes to their family when they pass, here's my passwords, here's everything, is a note with my card on it as well. But with they get a mortgage statement each month, and the family needs to reach out, as soon as the parents pass away within reason, and say, hey, my parents just passed away, and the servicer will say, okay, what do you intend to do? We say, okay, we're gonna sell the house, and then they ask for proof of a contract with the realtor, and then then they communicate with them. So you're right, though, Linnea, they do need to communicate, and so I just say, hey, these are you're going to contact your lawyer, you're going to contact whoever else, and you're going to contact the servicer and let them know what you want to do.
Does the servicer normally provide them with this sort of information, or is that just something they'd have to know themselves to ask?
They would have to know, and that's why I think that's why it's beneficial to work with somebody local like me that can talk to the borrowers about that and have that all set up. Whereas a lot of these companies, the Tom Selleck companies and so forth, they're phone trees somewhere around the country, and they're not walking them through all the steps that they need to take care of.
Yeah, and we know a lot of people don't do well with their estate planning. They sometimes they may have something like this, but they don't have that list that you're talking about. So that's something you need to discuss, obviously, with your elderly parents when they get to a certain point in time. Please let me know where your stash of stuff is that we need to have if you pass.
Yeah, it's a tough conversation too. My mom's 81 and she doesn't want to talk to me about it. She said, well, we're talking about it. That means I'm going to be gone soon. And no, but it is tough. So, but it's part of life. And yeah, we do have, being in the reverse side of things, I have seen things over the last few years that I would have never seen with a regular mortgage. I had a co-borrower pass away due to COVID, and this is something interesting. If we've got just a minute here, there are 2 liens that get placed against the property, both 150% of the property value, and that is to protect that keeps Medicaid from trying to get anything. And it this borrower called and she said, my husband just passed away from COVID, and I'm really scared that the hospital's going to come after us. And I said, well, you have 250% liens on your property. There's absolutely nothing they can do. Whereas if they owned it outright, or if they only had a $100,000 mortgage on a $500,000 house, then the hospital absolutely could put a lien on it. So there's some pretty good protection with these.
Okay, very good. Does anyone else have questions of Brian before we have a couple minutes to talk about haves and wants? This is good information. I know, Ella, you'll be providing us with our CE credits in the next couple of days or so.
Yeah, it usually takes about 24 hours if everything goes smoothly. So hopefully tomorrow, but definitely this week.
Great. Thank you, Ella.
Yeah, thank you.
Okay, yeah.
If we don't have any other questions of Brian, haves and wants, anybody? If you do, just unmute your mic and let us know what your haves or wants are. Well, it looks like we have a quiet group today. It doesn't look like there's anything else. And if not, I'm here at the office. Obviously, with Emily gone, I did get notification she's successfully landed in Ireland. So she sent me some pictures. And so I'm sure she's starting a well-deserved vacation. And I'm looking forward to having her come back because it's amazing for Brittany and me to be doing her job as well as our own. But it's good. It's all good. Keep it going, guys. If there's nothing else, we'll see you soon. I will forward the link. Ella will be sending everybody their CE credits. And I think that's it. Thank you so much, Brian. We so appreciate this. Good information.
Yeah, you're very welcome. Thank you. And feel free to reach out, any of you, anytime. Happy to be a resource for you.
Great. Thank you so much.
Yeah, thank you. Bye.
Bye, everyone.
Thanks. Have a good day.
Thanks, Ella.